Good morning from London. I'm Anna Edwards alongside Lizzy Burden. We're an hour away from the opening trade. Here's what you need to know. Pressure mounts on President Biden to drop his re-election bid as the first Senate Democrat breaks ranks in calling for a new candidate to face Donald Trump in November. Key UK growth data breaking this hour is set to provide evidence of the economic recovery taking hold. We'll bring you all of the numbers. Plus, Fed Chair Jerome Powell gives a cautious outlook on the inflation battle. This as investors look ahead to a crucial US CPI print for clues on the Fed's plans.
A very good morning. Welcome to Thursday. We're coming in from another hot session over in the US. The S&P 500 breaking through that 5,600 level for the first time. But we have European futures and US futures on both sides of the Atlantic pretty mixed this morning. You're looking at the two-year Treasury yield at 4.6% as we head towards the CPI print out of the US later. $1.28 on cable after those comments from Hugh Pill, knocking confidence in BOE cutting in August. Euro-dollar 108, Brent at $85 a barrel on the risk-on mood. But the countdown to the opening trade starts right now.
Welcome to the programme, everybody. 7:01 here in London for this Thursday morning. Let us take stock of where we are on markets. As Lizzy, you were saying, S&P, Nasdaq, global stocks all at new records. In fact, the S&P has hit new records for 7 sessions. Has been trading higher, for 7 sessions, which is not bad performance compared to the earlier part of the year. Tech stocks still to the fore, but we wait for the CPI print later. We'll be back then, Lizzy, to the topic of markets in just a moment. But markets are really preoccupied with what's going on in the United States around the NATO summit, and particularly preoccupied with watching how President Biden is performing on this international stage on the, outside of the set-piece events. So in terms of what NATO has delivered, we've seen, yes, support for Ukraine, and yes, calling out China, essentially, calling it a decisive enabler of Russia. But really it's the focus on Biden that has dominated the news flow. Chuck Schumer, Senate Majority Leader, saying, I'm for Joe, but then speaking to Axios, or reports in Axios, suggesting he's open to replacing Biden. Pelosi pretty lukewarm, suggesting that Biden needs to quickly decide what he's going to do here. And as if that weren't enough, George Clooney adding another name to the A-listers in Hollywood, or the big names in Hollywood, who are calling for him to go.
Yeah, so Biden's health a distraction, and all eyes on that press conference later. Everybody looking out for, unfortunately, another gaffe after the CNN debate. But the other distraction at NATO, of course, has been Donald Trump, and you've got lots of the officials trying to wine and dine officials connected to Trump in case he's back in the White House later. So we've got the geopolitics, the NATO summit, and the Biden-Starmer relationship. It's getting its first opening in Washington as well. They had their first meeting. They were discussing the football, but we can come back to that later. But on the UK, we have had the latest GDP data just dropping across the terminal, and it is 0.4%. So this is for May. It beat the expectations of 0.2%. It's up from 0% the previous month. And it continues this story, Anna, of a recovery in the UK economy, because we've had stagnation for the past 2 years, but now an expectation of rate cuts. We heard from Hugh Pill, the chief economist of the Bank of England yesterday, pouring, as I say, a little bit of doubt on whether there will be an August rate cut, but ultimately him saying that it's going to be a matter of when, not if, the BOE cuts.
Right. It's really interesting, isn't it? The likelihood of cutting then, seeing the moves yesterday from Mann and from Pill, the market dialing back its expectations of when we get that cut coming through. And the data coming in stronger than expected this morning will add to that. On the other side, we have this really interesting story asking questions about the OBR's forecasts and saying, does this Greta growth data make things better enough for the UK government, I suppose? Because if we did see the OBR cut its estimates of growth, and they're quite an outlier in how strong their forecasts are right now, could that once again make life difficult for the new Chancellor? But for the moment, this data looks stronger than expected.
Yeah, the OBR seeing growth of 1.9%. Economists telling us that they see 1.3%. Labour targeting 2.5%. But if they can't get that growth, Rachel Reeves, the new Chancellor, will have choices between tax cuts and tax rises and spending cuts.
On to a different geography and over to the United States, where we heard once again from Jerome Powell. He also in Washington testifying, dodging questions about President Biden, as that seems to be or suggest saying no, he hadn't seen any deterioration there. He then on the market said, or on expectations of rate cuts, he says he has confidence that inflation is receding, but he's not prepared to say he has sufficient confidence. moving sustainably to 2%. And we've got a nice chart that sets us up for the CPI data later on today. Yes, we saw that big ramp up in overall headline inflation and core services in focus, of course, now. All of that coming down, but looking pretty sticky on the right-hand side of this chart, just underlining the difficulty that many central banks around the world, and the Fed in this case, has in bringing CPI down reliably. The Fed, of course, focuses on PCE, but this is what the market is watching today.
Yeah, the politicians in Washington demanding cuts now, especially when there's this uptick in unemployment. But the options market betting on a 0.8% move off the back of this CPI print in either direction. It would be the biggest move since the last CPI print, which, of course, was the same day as the last inflation data.
OK, so that's the inflation story. That certainly will be one of the market events of the week to watch. And the options market, as Lizzy was referencing, very focused on this week. Let's tell you what else is coming up on the show today. We will discuss the fallout from the French election, still making news, with Stanislas de Bailliencourt from Sycomore Asset Management. We'll talk everything equities with Helen Jewell from BlackRock. BlackRock has an interesting new view on UK equities, so we'll move that into the mix. Plus, we're live at Bank of America's Breakthrough Technology Dialogue. We'll be speaking to the bank's President of International, Bernard Mensah, and Lightspeed Venture Capital's Bajul Somaia. All of that conversation coming up later. Interesting to see if they have response to what we've heard from the FCA around UK listing rules. And with that in mind, the UK regulators are overhauling their rules for companies looking to list in London. We're going to be speaking to Sarah Pritchard from the Financial Conduct Authority a little bit later on in the programme. Let's return, though, for the moment to our top story. NATO leaders have issued the alliance's strongest ever language, calling out China's military and its support for Russia during the group's 75th anniversary summit. Joining us now for more is Bloomberg's managing editor for the European economy and government, Ben Sills. Ben, good morning. Take us through some of the takeaways then from the event. There were these words on China that seemed pretty strong, and its relationship with Russia. Also support for Ukraine, of course.
Yeah, exactly. I mean, the language on China is very much in line with what we've seen from the G7 this year, as the US-led world really dials up its rhetoric and tries to take a much more kind of assertive approach with China. The measures on Ukraine, I think, were a bit more mixed. A lot of this stuff is commitments that we've already seen that are kind of being recycled for the cameras, unfortunately. And I think that speaks to a broader feeling of weakness that we've been picking up on the ground in Washington. Many of the leaders who are there, Biden himself, of course, are in a difficult position domestically, and that really limits the amount that they can do for Zelensky at the moment.
Yeah, you mentioned Biden being distracted somewhat. Other NATO leaders also courting Donald Trump. I do wonder whether, when you cut through the diplomacy, Ben, it's fair to say that Europe's given up on Biden.
Yeah, that may be the case. It was really interesting. We've been pushing our sources on the ground in DC for any sort of details of how Biden is performing this week. There's been no indications of any kind of major gaffes or stumbles, but at the same time, we've seen this procession of officials reaching out to the Trump camp, and most notably Viktor Orban, the Hungarian Prime Minister who holds the EU's rotating presidency at the moment, is going down to Mar-a-Lago once the NATO business finishes later today for a face-to-face meeting with Trump himself.
All right, Ben Sills, we thank you for that. You're in Madrid. I hope you'll keep those Spain fans in check as we go towards the finals of the Euros on Sunday for us. But let's look ahead to what else we've got coming up on the agenda for the day. It's a busy one. At 1:30 p.m. London time, we've got US CPI. Does it change the narrative of expectations for a September cut from the Federal Reserve? Of course, Jay Powell's also got his eye on the labour market, and we get initial jobless claims out of the US at 1:30 p.m. UK time as well, expected to stay volatile. At 6 p.m. London time, it's the US 30-year bond auction, and we're also going to get earnings out of Delta, PepsiCo as well, both facing higher costs and cautious consumers. And then just to add into the mix of the Fed speak, we're going to get plenty of it. We'll hear from Cook, Bostic and Muslim later as well, Anna.
Yeah, so a number of Fed voices. We heard from Lisa Cook yesterday saying that soft landing is still her base case, which, as a reminder, important to remind ourselves, that involves not much uptick in unemployment. That's still the base case. Of course, we could diverge from that, but there do seem to be a lot of people in the Fed, in the markets, who are still assuming that that's the case. So I guess that's what we watch on the Fed narrative.
Yeah, and Claudia Sahm herself of the Sahm rule talking about potentially some darker signs coming, but we're not there yet. But let's look at what other stories we need to watch out for this morning. Here in Europe, French President Emmanuel Macron has made his first public comments after snap elections left the country with a divided parliament and no obvious path towards a stable government. In a letter published in regional press, Macron called on parties that represent what he calls Republican forces to build a broad majority from the political centre. In other news, Archegos founder Bill Hwang has been found guilty of criminal charges stemming from his firm's 2021 collapse, concluding a 2-month trial that captivated Wall Street. The jury delivered verdicts against Hwang and his co-defendant, his former CFO Patrick Halligan, in Manhattan Federal Court after delivering for only a day and a half. And elsewhere, Hungarian Prime Minister Viktor Orban is continuing his trip around the world. Bloomberg understands he'll meet with former president and presumptive Republican nominee Donald Trump in Florida today after the NATO summit ends. It comes less than a week after he met with Chinese President Xi Jinping in Beijing and Russian President Vladimir Putin in Moscow. That meeting will likely fan concerns that the Hungarian leader is working as an intermediary between Putin and Trump. But Anna, you'll have to forgive my eye bags. I was up late last night. I stayed for that 90th minute. I'm not really a football fan except for Glasgow Rangers, but I can appreciate when someone's on the pitch and they're given a minute and they make it count.
Absolutely. I mean, that was an incredible substitution. I also stayed up. I was definitely had all my fingers and toes crossed that there wouldn't be extra time because that makes life challenging the morning after. But we talked about a lot of the serious stuff coming up out at NATO, and that's all, of course, worthwhile. But it was Keir Starmer's first trip internationally, as we've been saying, Lizzie. So really interesting to see him having a moment to watch the football and to watch the football, I think, with the new Dutch Prime Minister. So certainly that's in focus. There we go. There they are watching, maybe having mixed feelings about the result. But, you know, roll on Sunday. I think also that Keir Starmer was keen to use the football as a way to underscore this so-called special relationship with the United States. He gave President Biden an Arsenal shirt, we understand, which was, of course, to reflect his long support of Arsenal Football Club. But yeah, bring on Sunday.
Because he is actually a football fan.
Yes.
You know, a lot of prime ministers
not one of those politicians who pretends.
Indeed. But this was the first face-to-face meeting with Biden and Starmer, and talking about how they're the knot that binds the relationship. So that hopefully a prosperous relationship to come.
Coming up on the programme then, we will get your stocks to watch at the Open, including Novo Nordisk. This after the Danish drug maker's weekly insulin treatment fails to get approval from US regulators. That broke late last night. We'll have the details and watch for a reaction in our Sensational 6. Plus, the UK water regulator imposes a turnaround oversight regime on Thames Water as questions continue over the future of the business. We will have details. Up next, the French President Emmanuel Macron calls for a broad majority to shut out the far left and the far right from government. We'll be live in Paris thinking about bond market response. And if you have any questions for our guests, please do get in touch. IB plus BBTV Go is the function to use on the Bloomberg terminal. This is Bloomberg.
Now Macron won with a very Machiavellic, if we think about Italian history, it's a very Machiavellic operation. It was great in that. Now there is a government not easy to do, but there is Emmanuel Macron very strong in the international stage.
That was Matteo Renzi, former Italian Prime Minister and leader of centrist political party Italia Viva in Italy, speaking on this programme just yesterday. He was referencing Macron's strength on the international stage. Macron is distracted, if you like, by the international stage right now. He's over in Washington for those NATO talks. Let's think about French politics back at home, though, and what that means for bond markets. Joining us now is Stanislas de Bailliencourt, who's head of fixed income and asset allocation at Sycomore Asset Management. Stanislas, very nice to speak to you. So the news overnight seems to be that President Emmanuel Macron has called for talks in the centre. So he wants those centrist parties to see if they can do anything to put together a government so that he can try, so that the far right and the far left can both be kept out of power. Does this sound like a likely outcome, given what we saw voted for on Sunday? Does this sound like an outcome that the bond market will bet on?
That would be clearly the best outcome for markets, but there is no big bet on that today. It's still a very complicated situation. What is sure is it is going to take time for that to settle and to take place. Both extreme parties, and especially on the left side, are calling for Macron to give them the top job of prime minister. So clearly for markets today, they've been quite resilient so far. The French spread is at about 65 basis points, back from 85 at the top. So I think markets have understood that we are going to have a few weeks ahead of us of intense negotiations. They are now quite used to it. I mean, some other European countries like Belgium or previously Italy have had this difficult situation of building coalition. I think in French case, the difficulty is that there is a lack of experience of building coalition. So that's why it's going to take more time. And after that, I still think it's going to be a bumpy road ahead of us in the next few years, as both in case of a central coalition, which is not certain, there will be a huge challenge from extreme parties on each side.
OK, so even if we saw that centrist coalition come together, there could still be those extreme challenges. So where does that mean that we should expect the spread to be over the years ahead, Stanislas? This might be an impossible question to answer, but you referenced how it's come down from those highs above 80. This is the spread of OATs over bunds, of course. It's come down from those, but it's settled at around 65, so well above the 45.50 that it was at before Macron called this election. Where would you, does that make sense for it to hover around this kind of area, 65?
Yes, completely. I think, well, French spreads will be directly impacted by what happened, and also because the road ahead is a bit more complicated. I mean, from September, October, there will be the negotiation for the 2025 public budget, and we know that France is above 5% in terms of public deficit, and rating agencies are already starting to put a bit more pressure. S&P downgraded France at the end of May. So this new coalition will have a very difficult job, whatever is the coalition, even if it's on the left side or at best on the central side. So it's going to be a difficult job to be achieved going forward. There will be important measures to be taken. There is this deficit issue to be tackled. So I don't think, well, it will be difficult for the spreads to come back to the previous level in the 40 basis point range going forward.
Well, what sort of makeup of coalition would be preferable to the bond market, given you already had, Stanislas, these concerns about the budget before the snap election was called?
Clearly, well, what Macron is calling, so a central coalition, not taking both extreme sides, so neither Rassemblement National on extreme right or the extreme right with LFI, is clearly the best situation for markets. Markets tends to like young parliaments because it avoids extreme action on one side or the other. But again, it's a call from Macron. But so far, there is no evidence it can take place. I mean, it will be clearly received very positively by markets, but it's not a certain issue. Well, it's not a certain thing we can clearly bet on today.
And so for equities, do you see any opportunities out of this political uncertainty?
Well, clearly on the equity side, banks and insurance like AXA, BNP Paribas or Societe Generale were heavily impacted by the situation. The fact that there is a clear lack of visibility today on what can happen doesn't enable to have a real rebound for this company. Same for utilities, regulated utilities company, which have, of course, a clear link with regulation to French state. They were heavily impacted. All these stocks for the moment are staying a little bit where they are. Going forward, once a government is formed, once there is a true coalition taking place, if it's a central coalition, that might give an opportunity on that stock. But I don't think it's going to take a little bit of time. I think what we are seeing from investors so far, even though Europe had the good first half, I mean, economic situation is improving. We have the ECB starting to cut rates. We have inflation slowly going down. So we have a pretty supportive background. But this situation, the political situation in France, is a little bit not enabling this strong rebound for the stocks which were impacted by the decision of dissolution on June 7th.
Update us, Stanislas, on your thinking around the corporate debt market in France. We saw some issuance in France ahead of the elections, corporates trying to get in ahead and anticipating that there could be volatility, and we've certainly seen a bit of that. But maybe yields have not blown out and have remained tighter than some might have expected. How do you assess what we've seen in corporate debt?
I think, well, the credit markets, and when you're looking at fixed income corporate debt, has been very dynamic in terms of primary issues, even though going into the elections, so post the shock of the announcement, the markets were dynamic. Demands were strong, both from local investors for France, but also European and international investors, and even on high-yield names. So I think that was a pretty strong signal that even if it was a bit more volatile on the equity side, on the fixed income side, and even on the corporate debt side, there was strong demand from that, and we saw a lot of refinancings, which is pretty good for the maturity wall, which was coming in 2025. So from that point of view, I mean, it's really business as usual. Things are going pretty well. Corporate spreads are nearly back to the narrowest level for corporate credit and, in France and globally in Europe. So from that point of view, there is less impact than on the equity side.
And Stanislas, we've been talking a lot about the drama in Washington, kind of distracting from the NATO summit. But I wonder for you, how concerned you are about the headwinds from the US general election?
Well, I think this is a very good question. I think there's two very strong signs. The first one is trade wars have already started everywhere. And Europe is clearly in the middle of it, and it's a difficult situation with China and, of course, with the US, even before the election and the outcome of the election. So that's the first message. I think the second message we get from NATO is clearly, defense spending will quite likely move up in Europe going forward. There will be more to spend there. So this is also something to take into account when you look at budget deficits and things like that. There will be an effort to be made by states. So both trade wars are making the situation a bit more complicated for Europe. And there's also this defense issue, which is clearly now at the center of politics, and it's going to stay for some time, with important investment needed going forward.
OK, Stanislas de Bailliencourt, Head of Fixed Income and Asset Allocation at Sycomore Asset Management. Lovely to have you with us from Paris on the latest in the geopolitics and your outlook for France and the horse trading impact on the bond market. And also interesting comments on corporate on the corporate debt situation.
Yeah, absolutely. I mean, he was saying that it's actually business as usual in corporate debt in France, which is quite incredible, isn't it? But it's a reflection of the global nature of some of those big players in France.
Yeah, indeed. I thought it was quite funny, our clip from the former Italian president saying that Macron's gamble could work out for him. It's a bold play, but interesting to hear Stanislas saying as well that a hung parliament ain't such a bad thing if it can work out well. But coming up on the programme, you do not want to miss our exclusive interview with Bank of America's President of International, Bernard Mensah, which is going to be coming to you live at the Lenders Breakthrough Technology Dialogue event. Tom McKenzie will bring you that conversation coming up next. This is Bloomberg.
Welcome back to the programme. 30 minutes from the opening trade. Here's a look at the markets then for you. In terms of European equities, we are expecting a little bit of a move higher at the start of trade. The US session was strong yesterday. The Nasdaq and the S&P, new records on both of those, and global stocks also setting a new record. In terms of bond market reaction, we're looking for any response to what we've heard out of France, out of Paris, from Emmanuel Macron overnight. Not expecting to see a great deal. And then we have the yield at 3.19 on the French 10-year. That's well off the highs of 3.34, but still elevated versus the pre-election period. That's what we see on bond markets then right now. Looking ahead, of course, CPI will be a big focus for markets later on. The CPI print out of the United States. Let's move on. It's the third year of Bank of America's Breakthrough Technology Dialogue, which brings together more than 50 of the world's top CEOs, innovators and other key players involved in new technologies. Tom McKenzie has been invited to attend, and he is at the event at Goodwood in Sussex this morning. Tom, good morning.
Anna, yes, thank you very much indeed. Bucolic, Sussex. It may not look like it from the backdrop, but we are at this Breakthrough Summit, organised, as you say, by Bank of America, bringing together CEOs, entrepreneurs, VCs, academics, and of course senior executives from Bank of America to work through some of the key themes when it comes to technology. I'm very pleased to say, one of those senior executives joining me now, the international president of Bank of America, Bernie Mensah. Bernie, thanks so much for kicking things off with us. Let's start with the question of technology and how it is changing your world, the financial industry, particularly when it comes to artificial intelligence. What are you seeing in terms, as you project out, how does AI, how does technology transform your world of finance?
Tom, thanks, and great to be here. I think one of the things that we're figuring out is that the pace is moving quite fast. So one of the things we're trying to do today, which we've done over the last 2-3 years, is to try and anticipate where that is heading. So on the day-to-day, you know, there's this sense that we tend to overestimate what technology can do today, but underestimate what it can do in the future. So I think those of us in finance and in medicine and in materials and in plastics and in a bunch of different areas are trying to anticipate where things are going. And central to that technology architecture or innovation is AI.
And specifically when it comes to Bank of America and the services that you offer your clients, when it comes to client-facing services, are you at the point where you're implementing generative AI? Are you at that point? How do you see that unfolding? What does it mean?
Yeah, so we're very interested in generative AI. We're spending a lot of time on it, and we have a lot of people internally thinking through how we deploy that. We have to be careful. We're a hyper-regulated industry. In our consumer base in the US, we've got 60, 70 million clients. Now, we interact with them incredibly through machine learning. Our aircraft program allows you, Tom, if you're a client, to ask it what your balances are, tell you to pay John or Sharon. So that is happening. The focus right now is the generative piece and how we deal with that. But in terms of the patterns that we have, in terms of our ability to leverage a lot of the technology to provide solutions to our clients, that is happening anyway. In the generative space, absolutely, we're thinking through how best to deploy that.
How do you see it impacting jobs then within that space?
So that's so broad. I think that a lot of technologies have, my personal view is a lot of technologies have actually been accretive to jobs in the sense that whether it's automation from horses or whether it's electricity, people move on from maybe not making candles to doing something. It sounds very, very basic, but I do think that AI, if AI applies itself to robotics, advanced robotics, for example, I think that will free people up in that space to be creative in other ways, right? So machine learning, AI, generative AI, general artificial intelligence, reasoning, intuition, that's a spectrum that we're on, but we're early days on that.
What's on the business? What is demand looking like right now? Where's that demand coming? Are you seeing more demand for trading, more for investment banking? How is that picture evolving? How is it looking right now?
Overall, the business feels good. I would say that the markets have opened up a little bit versus last year. And we're seeing that globally. I was in India last week, and post those elections, the equity markets feel very strong. The US, we can see what the markets are doing there. So our clients are interested to deploy capital. Those that have invested are looking to see what the market solutions can provide. But in other areas as well that we operate in, whether it's in the payment space, whether it's transaction services, everybody's looking to optimize. Coming back to your technology point, people are trying to figure out what's going to happen in a year or two. Let's try and position ourselves for that because the innovation is so fast. But at the same time, reacting to where we think global GDP will be this year, reacting to the different elections.
Are capital markets coming back?
We've definitely seen some opening, absolutely. We saw the Aramco deal in Saudi. We saw an accelerated book build by London Stock Exchange here, and we're seeing activity in the US. So absolutely more than last year, and we've seen that in Q1 and Q2. The question is, does it continue through Q3 and Q4? Who knows? There are big election cycles. Sometimes people are a little bit cautious ahead of that. But at the same time, the central bank's posture will give boardrooms confidence.
Well, look, you've touched on elections now twice, so I want to go there. You have obviously been expanding headcount in Paris. You are based in London. You have that international profile. Yeah. There's some view, and we've been speaking to a number of guests, who've suggested that France has swapped places with the UK, or the UK has swapped places with France. Do you see it that way, given the political outcomes there?
I don't look at it in those terms. I think that what Paris has allowed us to do is to get deeper into our European clients. We're very excited about that. That isn't going to change.
Do you slow headcount add in France, given the political risk?
Well, we were at a steady state 2-3 years ago after when Brexit happened. We were one of the first to make the decision to say we'll have a lot of our sales and trading activity in Paris. By the way, we grew our office in Frankfurt, we grew our office in Stockholm, in Italy. So that has happened. So we very early on took ourselves from 100, 200 people to 600, 700 or so, and we feel good about where that is. And we want to just get closer to our clients. In a way, you might say that we will be looking to add or continue to drive into Scandinavia, into Italy, into Germany, figure out how we can get closer to our clients in Spain, etc.
Yeah. The UK had famously the trust premium on UK assets. Does France deserve a gridlock premium on French assets?
I think the UK had this temporary moment where the markets were trying to calibrate to what the government was doing.
Yeah.
But for G7, Northern Europe, France, Germany, UK, these are large, strong, sophisticated economies with incredible depth and, importantly, incredible talented people. They'll be fine. What those economies need to do is figure out what their priorities are, how much they want to lean into growth or not, and how distributive or redistributive they want to be. In the broad scheme of things, it might not feel like it, but actually these are problems that they can sort of get their heads around. And each of these countries are having a really intense dialogue as to what to do.
How are your international clients thinking about the US elections in November and how to mitigate the risk that is embedded in that political process?
I think that our clients are generally internationally, they're very bullish on the US economy. And we've seen a lot of inward investment into the US economy. And you can get a sense of where the dollar is. So wherever I travel, I think people are looking 6 months, 12 months, 18, 24 months. I think in the context of the election is really a question of, okay, does risk sentiment maybe slow down a little bit going into it? But beyond that, like with any election anywhere, you see what the new government's policies are or whichever government won again. Yeah. And then you adjust yourself to that. So do
they need to be kind of Trump-proofing their portfolios? I mean, there's a potential significant inflationary risk if there is a Trump presidency coming in January after that election in November, given tariffs, 10% tariffs, given what he wants to do with tax cuts. I mean, is that something that you would advise your clients to start thinking about?
No, I think our clients are, the US economy is so big, so strong, so deep, so sophisticated. The clients I talk to are not thinking in those terms. They're thinking over the next 5-10 years, where do we deploy our investments? And a lot of these, like us, a lot of these companies have been around many, many decades and more, and I think they'll be around many other decades. So they'll see whether it's the Democrats or the Republicans, they'll see what the policies are. And there's a lot of room within that for such a dynamic economy.
What would your message be to the new UK Chancellor, Rachel Reeves, to breathe life into the City of London?
I think that again, I continue to be bullish on the City of London. I think the engagement that they have had and they appear to be having in the early stages is terrific. I would encourage them to continue that conversation with all the participants in London. One of the brilliant things about London is that it is an incredible global convening place for capital. And it's not just capital, it's knowledge. It's the quality of people that are there and the diversity of people that are there means that it's rich with ideas. To my mind, capital is ideas, and the ideas piece is the most important. So I'd say to her that she's got the incredible advantage that she doesn't need to travel elsewhere to get a sense of what people are thinking about sustainability, about hybrid financing, about new technologies, as we're discussing at our breakthrough event here, about the potential of graphene or the potential of AI on life sciences or robotics, and how to finance that. And also in London, you get a sense of what global capital is thinking. So it's an incredibly, I'd say, privileged or incredible place to be sitting in. And I would encourage the government just to keep a dialogue with all the participants right on their doorstep.
Okay, Bernie Mensah, thank you so much.
Thank you.
Indeed. International President, of course, Bank of America, at the Bank of America Breakthrough Summit here in Sussex, on technology, on political risk, on capital markets. Guys.
Yeah, Tom, lovely bucolic background behind you there, and I'm glad you ended it on that note, because later in the programme we are going to be talking about how the Financial Conduct Authority in the UK is making the UK a more attractive place to list, overhauling its listing regime. But staying on the theme of Wall Street, from the Bank of America Breakthrough Technology Dialogue event, we're going to go to Archegos, the drama happening with that company, the Archegos Capital Management founder Bill Hwang being found guilty of criminal charges stemming from his firm's 2021 collapse. And we could get more on that story with Bloomberg's Charlie Wells. Charlie, just talk us through how the prosecution actually won in this case.
Lizzie, they had an incredible amount of evidence. They had text messages, they had 21 witnesses across 7 weeks, they had recordings, they had emails. And this was an incredibly complicated financial case. It dealt with derivatives, it dealt with $10 billion in losses for Wall Street banks. But at the end of the day, what the prosecution had to do here was pretty simple. It was two things. They had to show that Bill Hwang manipulated the market and then lied about it. And in order to do that, what they did was draw on two key witnesses. They were former employees of Archegos who dramatically turned on Bill Hwang, and their arguments seemed to land with the jury.
OK, so that's what clinched it then in the eyes of the jury. What happens to Bill Hwang now? Where does he go?
He could theoretically spend the rest of his life in prison. So he was convicted on 10 of 11 counts of wire fraud, securities fraud, conspiracy, racketeering, and market manipulation. Each of those counts brings with it a maximum potential sentence of 20 years. Now, this is white collar. He's very likely to appeal. And in white-collar sentencing, often those years in prison can be served concurrently. So that can bring down the number of time that someone could potentially have to spend in prison.
So given how monumental this trial is, does it actually change anything going forward on Wall Street?
That's a key question, Lizzie. And really, there have been no significant legal changes to legislation following this. The U.S. attorney for the Southern District of New York, Damian Williams, said yesterday that, this is a warning to those who want to cheat the system, but it looks like, at least so far, there have been no changes to hedge fund borrowing, to the way that family offices operate. And of course, Archegos was a family office.
OK. I had to feel kind of sorry for the jury, given that they had no financial knowledge of this. They had to get the Finance 101 in order to get to this verdict.
Steep learning curve, yeah. I imagine, to listen to those Archegos witnesses. Yeah.
Bloomberg's Charlie Wells, thank you for the insight into that incredible trial. But coming up on the programme, as we inch towards the market open, we're going to bring you the stocks to watch, including Novo Nordisk, after the Danish drug maker's weekly insulin fails to get approval from the US regulator. We've got the Stoxx 600, the Euro Stoxx 50 futures, I should say, higher 0.3%. We'll bring you more next. This is Bloomberg.
We want to be more confident that inflation is moving on a path sustainably down to 2%. Not at 2%, but on a path sustainably to 2%. That's the test we've articulated. I have some confidence, as I said earlier, that we are on a downward path. I think if you look at the data, it's pretty clear that, but we have not said, though, that we have sufficient confidence, and that will be a decision that our committee makes.
Fed Chair Jay Powell, of course, during his second day of testimony on Capitol Hill. Let's talk about the markets in 3 minutes. Paul Dobson, our executive editor for Asia Markets. Paul, it seemed that tech stocks were in the driving seat rather than Jerome Powell yesterday. We'll get to tech in a moment, but thinking about the day ahead, the trading session ahead, wherever you are, CPI in the United States is going to be the thing that investors are watching. Options markets thinking we might get quite a bit of volatility around this.
Yeah, well, Jerome Powell is saying that they need more evidence before they can be confident that inflation is on that slowing path. Today we get an opportunity to get a little bit of that from the data. If there's a confirmation of a continuing slowdown, you could expect markets to take heart from that, people moving to price in a Fed cut with a little bit more certainty maybe for September. I don't think July, based on what Jerome Powell's been saying this week, but September, could be on the table again. On the other hand, every time we felt like we've been getting this evidence that there is enough of a slowdown in inflation, we've flipped the other way. We've had some surprise data, and everybody's pushed back those Fed bets again. I mean, it's been the story for most of the year. So one way or the other, the market is going to have a little bit more certainty after that data, and so that's why people are expecting plenty of volatility in markets around the numbers release.
OK, so that's the US CPI print that we look towards later on. But the story yesterday, as Anna says, was all about tech, really. The S&P 500 crossing that 5,600 mark for the first time. I wonder whether we get another 8th straight session of gains today for the US stock market, whether there is anything that can stop tech, Paul.
Yeah, well, eventually there's got to be something. It can't go on forever. But I don't know whether Asia's markets, which had a pretty strong session, particularly for tech, was catching up with the US or pushing forward to what's going to happen in your trading day today. But certainly the likes of TSMC had a good day. We're looking at some of those tech names, Samsung, Sony, SK Hynix in our region, the biggest names still driving those gains. TSMC is, our equivalent of NVIDIA, just carries on going. It had good sales numbers. It's got, I think, earnings coming up next week. The sentiment is still behind it. This is a massive stock. This is 10% almost of the whole of the emerging market index now. So people still paying a lot of attention to that in particular. So continues to bode well. We'll see what can stop it. But maybe that inflation data might be part of it.
Meanwhile, Paul, in China, we've seen negativity in stock markets, $1 trillion of onshore market value wiped off since the middle of May, and regulators are watching and taking action on short sellers.
That's right. Some more action to try to short-circuit some of the losses in the Chinese market there with the crackdown on short sellers. We've seen, the measures themselves are making it prohibitively expensive, and some of the lenders of those securities are cutting back on their activities as well. That's seen some of the most shorted stocks in the market rebounding today, but everyone's saying, this is just a short-term measure. This isn't enough to give us economic confidence. This isn't enough to lead to an enduring rebound in the market. And if you look at the stock gauges, they're under so much pressure. They've been down for 7 or 8 weeks in a row. Foreigners are pulling money. Market breadth is looking awful as well. We do have the plenum coming up. People are hoping for a short circuit from that. But unless we get something soon, the market just will remain in the doldrums.
Paul, thank you so much. Paul Dobson, our executive editor for Asia Markets. Thank you very much for the update. Let's move from that Asia story to what's going on here in Europe and what we expect to see at the open of trade. Joe Easton from our equities team has a briefing on the stocks that could be on the move then. Joe, good morning.
Morning, Anna. So we've got a bit of a blow for Novo Nordisk today as the US FDA denies approval of one of its weekly insulin shots. The FDA says it needs to see more details on the manufacturing process and also expected blood sugar levels. And this was not expected by the market. Now, Novo says it doesn't think it will be able to fulfill the FDA's request this year. And this drug had actually already had approval in Canada and Europe. So it is potentially a little bit of a shock for the market today. We can see that Novo Nordisk is one of the best performing stocks over the past few years in Europe. Here down the bottom, we've got the index tracking the health stocks in Europe broadly, and there's Novo Nordisk rallying around 280% over the past 3 years. A lot of that driven by their key obesity drugs. But as I say, this insulin diabetes product, a bit of a shock for the market this morning. Then we're looking at banks. We've also got earnings today from one of Scandinavia's largest lenders. This is DNB, beating expectations on the top line in terms of their net interest income, rising almost 4% in the latest period. But in some of the commentary, it looks a little bit more downbeat. Muted loan growth in the first half, but they do think that'll pick up later in the year. The one place where they are doing good business at the moment is the bond market. They say they're doing a lot of trading there at the moment, so that could potentially take the sting out of that one. Here's the DNB share price on the screen on the orange line here. We can actually see that's a bit of an underperformer versus the broader banking sector in Europe. Scandinavian net interest margins have come down a lot quicker than in Europe, given expected easing in central bank rates over there. So that is a bit of a negative one, potentially a bit of a mixed one for DNB today. Finally, we've got a bit of M&A in banking as well. This is between Credit Ag and SocGen. Now, Credit Ag is in advanced talks to potentially purchase SocGen's German consumer finance business. It's called Hanseatic Bank and could be valued at around 600 million euros. This is according to a Bloomberg Deals exclusive overnight. And it comes as the SocGen new CEO looks to boost profitability and capital over at the lender. But the interesting thing about this sector is the underperformance that we've seen in a number of these stocks recently. We can see on the 1 month, here's the Credit Ag and SocGen share prices there. A little bit of underperformance versus the broader Stock 600 Banks Index. That's, of course, because of the French election weighing on these shares. So potentially there is a little bit of upside for them to catch up as that volatility eases. Keep an eye on the French lenders in European trading today.
Joe, and we'll also keep an eye on volumes on a day where a number of traders may have been distracted, certainly here in London, by the football. I'm sure you were not distracted by the football.
Yeah,
Joe.
no, my mind
eyes always on the news.
Yeah, I wasn't distracted at all last night. Yeah.
Did you also make the mistake of staying up, like Lizzy and I?
Well, yeah, no, I did depleted volumes today, I think, but we're struggling. We'll struggle through, yeah. Not much sleep last night, but it was worth it. It was well worth it.
Well, now we need your take for Sunday, Joe. What's going to happen?
A little bit worried about our centre midfield, but if we can hold on and maybe get our attack in play, we look like we could beat anyone last night. But yeah, Monday could be even worse for trading, I think.
Yeah, we'll see who's in the starting lineup. Some actual football analysis from Joe Easton. Thank you. We're grateful. Our equities reporter and part-time football pundit, Joe Easton, joining us there with the stocks that could be on the move this morning. We will certainly keep an eye on Novo Nordisk and all of the companies that Joe was talking about there. Coming up, we'll bring you then the market open. Futures are suggesting a bounce at the start of European trade today. US futures pretty flat to negative, though, so we'll see how that develops as we go through the session and as we work our way toward that CPI print out of the States later. This is Bloomberg. This is the opening trade. A couple of minutes to go until we get the opening trade here in Europe. Lizzy, let's take a moment to just step back and look at yesterday's session because it's quite instructive as to where Europe goes from here. This is Europe yesterday in blue. This is the US in white. And you'll see that we closed at a time when the US has not yet made its highs for the session. So perhaps that suggests a little bit of upward momentum for European stocks this morning. The US getting a particularly strong rally just towards the end of the trading day. Of course, we're looking ahead to the CPI data out of the United States. That's going to be the focus for markets. Maybe nothing moves around too much ahead of that, but a focus on tech stocks once again, no doubt. Lizzy, take us through the futures picture then for Europe.
Yeah, as you say, we have a risk-on mood. It looks like we're going to get a risk-on session out of Europe. Futures for the Euro Stoxx 50 pointing 0.4% higher. CAC 40 futures the same. FTSE 100 futures 0.2% higher. Although stateside futures pointing lower, but the risk-on mood here. In terms of individual stocks to watch in this session, Novo Nordisk, one that Joe Easton flagged for us after the US regulator denied approval for its weekly insulin shots. DNB Bank, we've had the earnings from this Scandi lender, one of the biggest, beating expectations. I'm also keeping an eye on Severn Trent, of course, after that Ofwat ruling on Thames Water. It's going to be put into special measures. Ofwat ruling coming in at the top of the hour. It's going to be an interesting session, Anna.
Absolutely. We'll keep an eye on what happens with those water companies as we go through the day then. All the politics, no doubt, will play out around that. But they didn't all of the players in that sector didn't all get what they asked for in terms of the return on equity they are able to give to investors, and that seems to be key. We'll get Jess Shankelman, our colleague who follows Thames Water very closely, on the programme a little bit later on. For the moment, though, we deal with the opening trade. 5 seconds to go until we get European equity markets opening up this morning. Let's have a look at whether we get that positivity, Lizzy, that you were talking about. So the DAX is open, pretty flat. The FTSE is open, pretty flat. So we have that upward momentum coming through from a late rally on Wall Street yesterday. That could send us a little higher. But at the same time, we're waiting for the CPI print, and on days where we get these big data prints, ones that options markets are really focused on, it can be tempting to sit on our hands and wait to see how this plays out. But we are seeing some modest gains across Europe, more than modest perhaps over in Germany. They're up by around 0.5%. The Stock 600 up by 0.2%. The FTSE 100 up by 0.25%. And we have the CAC 40 in the mix as well, up by 0.5%. So no French discount today when it comes to equity markets, at least. Lizzy, what do you see in terms of a deeper dive into markets this morning?
Yeah, if we look across sectors on the Stock 600, Anna, every single one of them in the green this morning. Technology leading the gains, up 0.4%, so continuing that mood from yesterday's session in the US. The sentiment very much here in the European session as well. Bottom of the basket is media, but it's just flat to the upside. Everybody, as I say, in positive territory this morning. I did say that we should be looking out for Severn Trent, and those shares are up 2.2% this morning. Novo Nordisk just slightly in the red. Crédit Agricole, we were talking about the M&A talks potentially with SocGen, with all the French election volatility in the background, and Crédit Ag's shares up 0.7% at the open.
OK, yeah, interesting to watch what happens with technology stocks. The read across from the United States, never quite, 100% and direct across the Atlantic. But we do see tech stocks gaining a little. And yesterday, Lizzie, it was the tech stocks that were in focus, as we've mentioned a number of times. And once again, we find ourselves asking whether the earnings season in Europe, in the US, can live up to expectations, certainly for some of those big US tech names, whether they can really deliver on some of the things that they have been promising. Let's just play you what we heard from Peter Oppenheimer yesterday from Goldman Sachs. He joined us on set and had thoughts on the earnings season ahead.
Don't want growth to be too low either when confidence is so high about earnings coming into the second quarter. So I think the real, catalyst for maybe some kind of softness in the equity market is any disappointment in the second quarter. Remember, expectations are running pretty high, and particularly so for the dominant stocks.
Chief Global Equity Strategist and Head of Macro Research for Europe at Goldman Sachs, Peter Oppenheimer, speaking to Bloomberg Television just yesterday. Let's get the thoughts of Helen Jewell, CIO for BlackRock Fundamental Equities EMEA. And Helen is with us on set. Hi, very good to see you this morning, Helen. Let's start with this sort of big picture question then around the earnings season and where that goes. We were just hearing there from Peter Oppenheimer that, if there are cracks in the equities strength story, then maybe they come from the earnings season. Is that your expectation?
Yeah, I mean, I absolutely agree with Peter there, where he talks about the need for the earnings to come through. All eyes are on earnings, and any disappointments will be penalised pretty hard. But where I would disagree with Peter is I don't think expectations are naturally too high. Actually, expectations came down. And then what we saw is earnings expectations increased by 1.5%. That is not a crazy re-rate in terms of earnings expectations. So I don't think that earnings expectations on the whole are too high, even though I do agree that any misses are likely to be penalised by the market, whilst we're in this kind of slightly cautious risk-on kind of environment that we're seeing right now.
And we've talked to you a number of times, Helen, about whether we see equity markets in Europe benefiting from that broadening out of the rally in the United States to the extent that we see it, and it tends to vary day by day. But we've been looking actually at where Europe has been performing as well as the US, and that's in a sort of broader measure of US stocks, but it's certainly not keeping up with the high flyers and the tech names. What's the latest thinking on how Europe does in catching up with what we've seen in the US?
Yeah, no, so that's going to be the key focus, and I think it's really difficult at the moment. You've got these few dominant stocks in the US that really are driving the market there. But we do still think that over the next 6 to 12 months, the breadth of what you see in Europe means that if you are going to see one or two of those names get hit, just by the law of averages, it's not going to be the same impact on the entire market than what you will see in the US if you do see that much narrower type of market get hit. So we do think that's a real positive for Europe. In addition, obviously, what you've got in Europe is the ECB have already cut. Now, today is going to be incredibly important in terms of that CPI print and in terms of what that indicates for any potential US rate cuts. But in Europe, we are still seeing the rate cuts starting to come through. On the flip side, we've seen geopolitical risk. You can never put that away. But there is no doubt in Europe, the breadth of the market is going to be a real advantage, I think, during the earnings season.
So that's the earnings picture, the central bank picture. But what about the politics? Is it actually casting a shadow over European equities, or will it if the uncertainty drags on?
Yeah, I think what the recent geopolitical risks has really done is just show why that valuation gap is there. So I think last time I was on, I was talking about the valuation gap shrinking. It did start to shrink. And then, Lizzie, guess what? It started to pull back again. And it is quite frustrating when you see that. I think we have to accept that in European markets, the equity risk premium is higher. And there is a reason that it is higher. It is the geopolitical risks. It's higher return names. But the earnings is the key thing in Europe that we need to remain focused on. And again, it's this breadth of earnings that we see within Europe that you don't necessarily see in the US that will give us that positivity in the next 6 to 12 months in the near term. So no, I'm not going to say geopolitical risks have gone, but let's not overlook the earnings.
So they're not gone, but then if you break it down and you look within Europe, actually the UK's got some political stability. So does that actually make the UK a bit of a safe haven when it comes to equities?
Yeah, I mean, I think the UK is a really interesting story. The valuations are incredibly cheap, and there is no doubt what we're hearing and seeing from investors is they are looking at the UK once again. The political stability and the valuations, those two things combined means that the UK is of interest. I wouldn't necessarily call it a safe haven. I think that the entirety of Europe is really a safe haven because of the quality names and that breadth that you've got. So the UK is much more about the valuation story. I think actually more broadly in Europe, you've got some really, really interesting opportunities.
Well, I mean, you've been excited about the European construction sector for a while. I wonder, with all of the announcements on house building from the new Labour government, whether that makes you particularly excited about the UK construction sector.
Incredibly excited. And what I love about construction is you've got two things coming together. You've got the cyclical side of things. So the construction sector, by its very nature, is a very, very cyclical sector. On top of that, you've got the structural side. So from a structural perspective, construction, we need homes to live in. And what we're seeing is kind of a political stability that allows those homes to be built. So structurally, it looks interesting. And cyclically, it looks interesting. And that's a really interesting place to be.
We heard from the Bank of England's Hugh Pill yesterday. He was saying it's when, not if, we get that rate cut. But then we got that GDP data out this morning. It's just 1 month, but it's 0.4%, which is higher than 0.2%. You've got a government that's talking a lot about growth, growth, growth. Some of that will take time to deliver. Maybe some of that comes soon. I mean, we've got the football, lots of people spending money in the pubs. That'll be a short-term boost. But is there a risk that we don't get the rate cuts that many people are expecting in the UK, or we don't get it very soon? And that could be a risk, again, to that construction sector call.
I don't think... I mean, of course, there is a risk in terms of if interest rates get pushed back or interest rate cuts get pushed back incredibly, then I think that is going to be a little bit of a dampener on the markets. But I think it's really important we don't get too fixated by whether that is September, October, November, December, exactly when it is. And that's true for the US as well. There's going to be a lot of focus. Is it September? Is it later? The key thing is to Hugh's phrase, as long as it remains when, not if, and as long as it doesn't feel like we're going to be waiting 12 months, then let's not get too bogged down in the exact month of when that rate cut is going to come. The positivity, the feeling that inflation is coming back into control, that is what is going to give us that excitement in the market. And again, it is risk on, but it is cautious risk on. And I think that is what you're seeing when people are just navigating these data points as well. So let's not get too fixated on the exact month.
Well, let's just pick up on that, because after the GDP print, actually, you didn't see a change in the rate cut bets from the Bank of England. The move was more from Hugh Pill yesterday after his comments. But just, you're so optimistic, Helen. I need to find a little crack in it. What are the biggest headwinds on the horizon, then?
I'm optimistic as well, because of England. It's given everybody a bit of a boost this morning. But the key risks do remain if inflation does remain sticky up for longer. There is no doubt that we have to be very cautious that it goes back to this point. If interest rates do feel like they are a long way away in the US and in Europe, that is going to really put a bit of a sink on the market. The other key thing, going full circle back to the start and what Peter was saying yesterday, these earnings do need to come through. Any crack in those earnings, and I don't think we're going to see them, but of course you do see news flow. We've seen already some today. Any news flow that is not perfect or close to being perfect will be taken negatively by the market. That is the key concern that I have. And I sometimes feel I say every earnings season is important. It's why they're important. This earnings season is important to really show whether or not those earnings can come through. And if they don't, I think we will start to see a bit of a turn in the market.
It does feel like we were saying that last time. 3 months ago, Helen, we were saying, you know, this earnings season is important because we need to see the likes of Nvidia justify its valuation, and then it did. We also asked whether we're going to see a broadening out of the AI trend. Is there anywhere in particular in Europe that you're looking to see more evidence of that? I mean, any company that supplies data centres, of course, is an obvious one. But when do we start to see the breadth of that AI impact coming through in the earnings stories?
Yeah, I mean, where it's really going to come through is in those data companies, utility companies, chip companies. We've got phenomenal chip companies here in Europe as well. We don't have that same level of breadth in terms of kind of direct exposure, but it is those secondary companies that we see. There's data companies in the UK as well, which are really interesting. So that's where the breadth is coming. But when I talk about breadth in Europe, it's not just breadth on AI, it's quality breadth across different sectors. And that's what I think makes it particularly interesting, is you're not just focused on AI, you've just got a much, much wider group of really interesting quality companies in Europe.
And you don't think that the questions around France, which we've asked many times of many guests, have always focused on, yes, short-term instability or uncertainty at least, but then these are big names with big exposures internationally. They're not a reflection of the French economy and all the policy making that you might see taking place at the National Assembly. Where do you stand on France and its sort of exposure to the rest of the world?
Absolutely. I think it's really important. It goes back a bit to Liz's point on the UK, to differentiate between the broad indices, which are very internationally focused, and the much more domestically aligned indices, and the separation that you see between the performance of those different indices. For us, a lot of where we're investing in France is in those international companies. And there, what we've seen in the pullback is real opportunities. What you see in the much more domestically focused indices, they are the ones that do need that political stability. We've seen in the UK that the performance of the FTSE 250 has been very interesting. So they are the ones that perhaps is a bit more of a wait and see until we see what that stability looks like. But really important to differentiate between the large cap quality names in France and the UK and generally in Europe versus the ones that are a little bit more domestically aligned. And they are the ones, of course, by very nature that are going to see the real kind of political impacts. But the valuations is so important. Look at the valuations that we continue to see in Europe. 13 times versus 21 times in the US. It's impossible to ignore that valuation gap, even if there are reasons for it.
OK, that's interesting. An interesting point to leave it on. We'll see what the earnings season delivers then in that regard. Helen, thank you for joining us this morning. Helen Jewell, CIO for BlackRock Fundamental Equities EMEA. Let's have a quick look at the Core 6. We've been talking about Novo Nordisk and how that business has been disappointed in the United States in the last 24 hours by some of the decisions around its weekly insulin treatment. That stock is down by 0.2%. We see a little bit of strength in LVMH, talking about international nature of the French market. A mixed bag, really, for the Core 6 this morning. Let's take a deeper dive into the individual stock moves. Joe Easton is back with us. Joe.
That's right, Anna. We go from the excitement of the football to the excitement of UK water regulation, because we have got a draft document out from the regulator out today on the amount of money that these companies can earn over the coming years. And it's actually looking better than expected today. We're seeing gains of around 6% in Pennon Group, also Severn Trent, United Utilities rising. There was potentially some concern that the profits would be constrained by the regulator, but that isn't the case. And markets are actually liking this. I've seen a Morgan Stanley note out saying this is very positive for the sector today, one of the best performing sectors we've got at the moment. We've also got some other earnings as well in the UK. A couple of decent movers I saw. There's DNB. We had that one in stocks to watch. Better than expected net interest income, but also the bond market doing pretty well for that company over in Scandinavia as well, up almost 5% there. But Barry Callebaut dropping around 7%. That's the biggest decline in about 5 years for one of Switzerland's biggest chocolate makers. The thing for them is the higher cocoa bean price. That's what they're saying, really hurting their profits this morning. We've also got Hayes. This is in recruitment. It follows Page Group earlier this week with a bit of a profit warning from them, saying a very similar thing, actually, declining fees in the recruitment market, hitting that sector at the moment. And finally, Jet2 down the bottom here, the package holiday company. Actually, some interesting comments around people taking longer to decide on when to book their holidays, but that is not actually feeding into the stock, seeing a bit of a gain. The bookings remain reasonably strong at the moment. Then we'll take a look at Novo, coming down only very slightly. The FDA not approving this weekly insulin shot for the company that had been approved in other markets, but that stock really driven by the obesity thesis at the moment, so not doing too badly, only down at 0.2% at the moment. We'll check in on the French lenders. We did get that news of Credit Ag looking at SocGen's German consumer finance business, according to a Bloomberg exclusive. That's worth around 600 million euros. That stock gaining 0.7%. Credit Ag also very slightly higher today. Couple of morning calls to bring you. Firstly, we're going to look at the train sector. Alstom gets an upgrade at JP Morgan. They reckon the decline on capital concerns at the French company is overdone, so they reckon you should be buying that one at 21.80 euros. It's at almost 17 now, so decent upside for that one. And finally, another upgrade today is Novartis. This one is upgraded at Oddo. were gaining 1.5%. They think the cancer profile of the company will continue to boom in terms of their oncology treatments, and that stock is gaining today. Novartis up 1.5% in Switzerland.
All right, Joan Easton, we thank you for that look at the stocks to watch at the open. The movers, as we are quarter of an hour into the session, the stock 600 higher 0.2%. You've got more sectors actually inching into negative territory now: autos and parts, energy, media, basic resources. But really good of Joe to talk about the utilities and water, the impact of this ruling by Ofwat, the UK water regulator, on Thames Water, I should say. Actually, Severn Trent and United Utilities, as he says, benefiting from that. But just across the terminal, we do have the possibility that Thames Water, which is, of course, the biggest water and sewage company in the UK, could be broken up. It could be listed on the stock exchange. It could be forced to cap its debt under these special measures that have been set out by the regulator. So we're going to be talking more about that in the next part of the programme, and a very big question as well for this new Labour government, how they're going to deal with it. I know you talked to the business secretary, the shadow business secretary as he was, when you did the Jonathan Reynolds at our UK business election debate about the potential nationalisation. Let's talk about those policy measures, but also how the company is going to handle this. That is what's coming up next on the programme, tightening the pressure gauge as Thames Water's placed under this special regime to save it from collapse. Stay with us for that conversation. This is Bloomberg. Welcome back to the opening trade. We're 20 minutes into the cash session here in Europe, and the positive mood has spilled over the Atlantic into the European session. The stock 600 higher 0.1% currently. That positive mood from the tech record-breaking session on the S&P yesterday is here this morning. Only about 5 sectors in negative territory this morning. Consumer products and services leading the gains. But we have had an important ruling this morning from the UK regulator on water. This is Ofwat, and Thames Water, it says, is to be placed under a turnaround. The oversight regime to help lift the UK's biggest water and sewage company out of crisis. UK regulator Ofwat also set limits on returns and price rises for consumers. And to talk us through the significance and go through all the details with us is Bloomberg's Jess Shankerman. She's been covering every twist and turn of this story. So, Jess, you've been through the document. What's your main takeaway?
Yeah, the big surprise today was Thames Water being put in special measures. Obviously, there's still proposals, but it's quite likely to happen under Ofwat's proposals. We've got a new Labour government that has said it wants to put failing water companies into special measures. Thames is taking steps to try and tackle chronic leaks and sewage spills, but it is still, according to the latest documents, a failing company. It's lagging behind all the others, and it's incurring penalties on that. So under the plans proposed by Ofwat, they could put in an independent monitor that would have access to all of Thames' documents, and it could break up the company, it could force an IPO, or it could cap the level of debt. Thames is obviously the highest indebted company of all the 16 water and sewage companies in the UK.
So that's what special measures could mean then for the business. It seems like there's a lot of different options, a lot of different directions this could go. For the future of the business, they're going to want investors and investment. The return on equity rate that is regulated by the regulator was seen as key. So what has Ofwat indicated they're going to allow businesses like Thames to return to investors?
Right, yeah. So Ofwat sets the return on equity, the return on debt, and together they make the WACC, which is the weighted average cost of capital. Thames said it needed a return on equity of 5.7% to make it attractive, to get new investors. Obviously, their investors, their current shareholders, walked away from the business at the end of March. They said the business plan is uninvestable. Ofwat has set regulations that are too tight and we can't do this. So Thames said we need 5.7%. Ofwat said 4.8%, which doesn't look like it's going to be enough, but obviously it kind of remains to be seen, because there is definitely a lot of brinkmanship going on at the moment. You know, a lot of people thought, even with the shareholders walking away, were they genuinely walking away, or was it a game to try and push Ofwat into giving them an easier time and adding some leniency.
It's interesting, that return on equity point, Lizzy, because this is all in a new regime of higher interest rates. So then if interest rates start to come down, to Jess's point, that'll have an impact on the return on equity and the weighted average cost of capital that businesses will require when they invest in Thames. So that's why there's such a focus on this particular dynamic.
Yeah, and of course, with interest rates coming down, it brings us to the consumer angle on this. We're getting to the tail end, it would seem, of a cost of living crisis, but a crucial part of Thames Water's plan that was being ruled on by Ofwat here was how much prices could be increased. What's been the ruling, Jess? And, what are the consumer groups reacting to this? Are they mad?
We haven't had any reactions so far, but I can guarantee they are going to be very angry. The water companies are going to be very unhappy that they've had their investment plans cut back and their proposals for bill rises cut back. The consumer groups are going to be very angry that we're going to see bill increases at all. Just to put this in context, since privatisation in the 1990s, the focus has always been on low bills, and we've traditionally had very low water bills in the UK, perhaps not really reflecting the true price of water. Now, in the past 5-6 years, we've seen a huge focus on pollution, environment, the need for water companies to tackle sewage, to tackle chronic leaks, and that means that the bills will have to rise. So Ofwat has cut back the proposals from investors, and they're saying that on average bills are going to rise by about £19 a year over the next 5 years.
So we know that Thames Water is going to be put in this turnaround oversight regime, and you've referenced some of the, some of the different paths it could take. I mean, where does this leave the business? What is likely to happen to Thames Water?
Yes, this is all crucial for Thames Water. They need to raise new equity. Chris Weston, the CEO, was talking on Tuesday at their annual results saying we could run out of money by June next year if we can't find new equity, and that could very easily happen because if Thames is unhappy with the proposals that Ofwat's made, we're not going to have a full final decision until December. This is only a draft decision today. It's possible that Thames and other businesses could take the ruling, appeal the ruling to the Competition and Markets Authority, which could drag on for a year, which means that it could be very difficult for Thames to get a deal with a new equity provider while that's ongoing.
OK. And have they said anything about pay and CEO pay? Because I know for a lot of journalists covering this story, that has been a key area of focus.
Well, it has, and on Tuesday it was revealed that Chris Weston, who joined Thames in January, has already received a bonus of £190 million for doing really well at running this failing business. And there was obviously a lot of anger around that. Ofwat hasn't said anything about it, about bonuses specifically today, but the government has said that it's going to crack down on bonuses and make sure that if there is any money left over that companies had said they would spend on infrastructure, they're not siphoning that off to pay bonuses, pay increases and dividends.
Jess, thank you very much. A complex story and Jess all over the details, so we thank you for coming to explain it to us. Jess Shankelman from Bloomberg News with the details on Thames Water. Coming up on the programme, we'll be back to talking about technology. Don't miss our exclusive interview with Lightspeed Venture Capital's boss. He's going to be joining us shortly. That's from the Bank of America Breakthrough Technology event. A really interesting day for Tom McKenzie to be down there in Sussex at this technology-focused event. We've heard from the FCA about how they want to change listing rules, perhaps to attract more tech listings into the UK market. I wonder if that's something that's being talked about down at Goodwood. That conversation coming up shortly. This is Bloomberg. This is the opening trade, 30 minutes into today's session, and European equity markets making modest gains as we wait for the CPI print out of the United States later on today. That is going to be the focus for markets. Will that set the stage for a rate cut in September? Could it come as early as September? That is what the market is asking itself right now. One sector in focus today is the water sector, very dependent on where we go on interest rates. And just to correct something we said in the last part of the programme, the bonus taken by the CEO of Thames Water was £195,000. This was for the 3 months to the end of March, taking his total pay to £437,000. So those are the numbers that we should have mentioned in our last conversation when it comes to CEO pay. Let's put that sector to one side and bring technology into sharper focus. We are, this morning, Tom McKenzie is at the Bank of America Breakthrough Technology Dialogue event. That's taking place in Sussex. It brings together more than 50 of the world's top CEOs, innovators and other key players involved in new technologies. And Tom McKenzie is there at Goodwood in the UK for an important conversation around the UK and tech. Tom.
Anna, thank you. Yes, very pleased to say I am now joined within that mist, the executives, the VC founders, of course, the bankers as well from Bank of America, of course, now joined by Bajul Somaia. He is partner at Lightspeed Venture Partners, also co-leading the business as well. Lightspeed has about $30 billion of AUM, of assets under management. And Bajul, unsurprisingly, a big part of the conversation last night at this event, leading up to this event, and this morning as well, has been around generative AI and how to think about the impact of that. As we look across the AI stack, where it's the hardware, the chips, the data centers, the foundation models that are built on top of those, or the applications on top of the foundation models, where within that stack is Lightspeed looking for opportunities right now?
Yeah, morning, Tom. Well, I think the starting point is always the infrastructure. Without the infrastructure, we can't really build things on top of it. And so a lot of the investment last year in the industry generally, and including Lightspeed, was at the foundation model layer. OpenAI, obviously, we're investors in a company called Anthropic on the proprietary model side, and then in a company called Mistral on the open source side. Because I think we will see roles for both proprietary models as well as open source models. What we also see then, these are the general purpose horizontal models. There are certain use cases or formats that we believe may require vertical specific models being built all the way through to the application layer. An example would be a company like Suno, which is arguably changing the world of music creation through a combination of foundation models and then user-facing applications. So that's been sort of a little bit of the first generation of companies. The next question is really, how will enterprises use these models? How will they use their data? They can't just wave a magic wand. There's a whole stack that's really got to get built. And we're thinking a lot about what this enterprise stack looks like in an AI native world. And so everything from databases to security, testing, prompt engineering, data governance, data management, and which parts of that may be won by incumbents and which parts of that stack will need net new companies to be built. And so the tooling and platform layers are now where we're spending a lot of our time.
Okay, that's very interesting. And that's the focus because, of course, as you say, you've invested in Mistral and Anthropic, two really, really big names in terms of the world of, in the world of foundation models. Are you concerned that there's a bit of a commoditization coming in for those foundation models? I was speaking to Jonas Androulis of Aleph Alpha, based in Germany, also a large language model. And he says, and he questions, how does OpenAI actually turn a profit? There is a commoditization effect going on here. Is that a concern?
Well, look, what we're obviously seeing, and I think we would have anticipated seeing, is API call pricing coming down. Now, I think the most dangerous, our perspective is perhaps the most dangerous perspective to have at times like this when technologies are changing so rapidly, is to think that we know what the answer is going to be. We don't, right? But here's what we believe, which is that in a world in which the volume of calls expands exponentially, which we will see as more and more enterprises adopt generative AI. And now if you think about an agentic world, where each of us may have multiple agents operating on our behalf, and enterprises will have agents operating on their behalf, also making calls, well, then the volume of calls that are made on these foundation models is going to be absolutely massive, right? And so while the price per call may come down, the volume of calls will be extremely high, and we expect compute costs to decline. And so I would argue, in that world, these companies at scale will absolutely be able to make a profit, right? But we don't know. These are things that we don't know, but I think it's dangerous to be too rigid with a particular point of view, and we're remaining open-minded about all of these possibilities.
Is there pressure that you put on some of these companies around monetization? Are you getting to that point where you're having those conversations? You need to start monetizing some of these products.
Well, look, I think these founding teams recognize, given the cost of compute and the capital intensity of these businesses, there's only two ways you can manage the capital intensity. One is you will keep raising capital. The other is you've got to earn revenue. And I think the answer will be both. You can't rely on the capital markets. The private markets have been have embraced these companies so far, right, with these companies raising billions of dollars and most recently XAI raising close to $7 billion. So capital is available. But you can't assume that will always be the case. And I think we're beginning to see companies like OpenAI and Anthropic begin to scale revenue very fast.
Okay, interesting. In terms of the venture capital world and the structure within that sector, so Lightspeed's done something really interesting, which is looking at this continuation fund. So essentially allowing investors or to take about $1 billion of stakes in your portfolio companies, so freeing up about $1 billion across the portfolio. It's a PE-style structure. What is the rationale behind that?
Yeah, the rationale behind that is that companies are staying private for longer. And at the same time, we want to be able to support those companies, yet recognize that some of our LPs that are investors in the funds that are invested in those companies, it's important to drive liquidity back to them. And so how do we solve both of those problems? Well, it is, for example, to take a set of what are still very healthy companies that are compounding in value and put them into what we call a continuation vehicle where the underlying LP base may change, right? That provides liquidity to LPs that want it. Others may not, and they can roll over. And it enables Lightspeed to continue to steward those positions and continue to be a partner to those companies.
I know that you spend a lot of time in India, Southeast Asia, but India is part of that mix as well in terms of the region for you, and it's an important market. There have been some challenges for some of the startups there. I'm thinking of Bajul, for example, once India's most valuable startup, now challenged in terms of whether it can even survive. Paytm as well, in something of a crisis. Is the VC community turning sour on startups in India?
I think the headline is it isn't, but these kinds of episodes are always sort of they make a dent in the ecosystem, right? But it forces you to ask the question of what's really happening here. And when you look at the political stability in India, when you look at the macros in India, when you look at public market stock performance in India, you look at central bank management around interest rates and inflation, all of those continue to be very strong. You look at underlying company creation, digital adoption, quality of founders. You know, we've got to be first principles, and all of those foundations of the economy are quite strong. And so I think these are bumps in the road. They happen in all economies, and we remain quite optimistic.
So above and beyond India, more broadly, when do you see a turnaround in exits? When do IPOs come back? When do the public markets start to give a lift?
I wish I had a crystal ball.
Yeah.
You know, we were fortunate to take one of our companies, Rubrik, public earlier this year. Strong company. It's a reminder that the public markets are open for good companies, but that the bar to get public has gone up. And so I think the way we think about this at Lightspeed is we can't assume that the public markets will reopen. They will enable the best companies to get public. But we have to be creative and thoughtful about driving liquidity to our LPs. And there's a range of ways we can think about that and have to be thinking about it. I don't think the venture capital industry can continue to assume that liquidity will happen to us in the way that perhaps the industry operated 10 or 15 years ago.
Okay, Bajul Somaia, thank you very much indeed. Partner at Lightspeed Venture Partners, co-leading the business, again, AUM of around $30 billion US. Some really interesting, of course, investments in the likes of Mistral over in France, Anthropic, of course, in the US, Nest, Rubrik, and a ton of others, of course. Really consequential in terms of the startup space and the view around liquidity in those public markets, maybe not coming back quite yet, guys.
An excellent conversation. Bloomberg Tom McKenzie, our daybreak anchor at the Bank of America Breakthrough Technology Dialogue event. We thank you for that conversation. And really interesting to get the investor mood there from Lightspeed on IPOs globally and here in the UK. And it's what we're going to be talking about next. We'll talk about the overhaul of the listing rules here in the UK by the Financial Conduct Authority, the regulator. Just to bring you some statistics, according to the latest UK listing review, the number of listed companies in the UK is fallen about 40% from a peak in 2008. So can these new rules turn its situation around? We're going to be speaking to Sarah Pritchard, the Executive Director for Markets and International at the FCA next. So stay with us. This is Bloomberg.
We've
definitely seen some opening, absolutely. We saw the Aramco deal in Saudi, we saw an accelerated book build by London Stock Exchange here, and we're seeing activity in the US. So absolutely more than last year, and we've seen that in Q1 and Q2. The question is, does it continue through Q3 and Q4? Who knows? There are big election cycles. Sometimes people are a little bit cautious ahead of that. But at the same time, the central bank's posture will give boardrooms confidence.
That was Bank of America's President of International, Bernard Mensah, speaking to Tom McKenzie a little bit earlier, talking about return of confidence in capital markets activity and a rebound in capital markets activity, better than last year, at least seems to be the way that he was describing it. Where does that leave the listings environment around the world? Well, the UK is hoping to play a bigger role in that listings story. UK regulators are set to overhaul their rules for companies looking to make their public debut in London. This is part of the FCA's effort to draw more IPOs to the city. What can be done? What do the rules involve? Sarah Pritchard joins us, Executive Director for Markets and International at the UK's Financial Conduct Authority. Sarah, very nice to speak to you. Thank you for joining us. I wonder how you would characterise the change in rules today. Would it be right to say it's a necessary but not sufficient step towards levelling the playing field for IPOs between London and other parts of the world? Is this enough for the London market to catch up with the rest of the world?
Well, thank you, Anna, and thank you for having me to explain what are the biggest changes to the UK listing regime in over 3 decades. What we're seeking to do today is to announce a simplified regime that maintains high standards, that compares well internationally and looks to help boost UK stock markets. We want to see a regime that is right for the UK and internationally competitive.
Right, yes, so you want to see that. But is this enough? Is this going to close the gap? I mean, you're doing what you can, I suppose, from a regulatory point of view. But should we expect more to come? I was interested to see that Labour and the Conservatives both said ahead of the election, after you put out your draft rules, that this wouldn't necessarily be enough and they were looking for regulators to do more. Is there more to come on this front?
So what we've done today is we've very much reduced some of the frictions that we've heard from corporates that get in the way, that are barriers to some entities considering the UK as a destination to list. So we're very much looking to simplify and reduce some of those frictions. So my message to companies that might be listening is, if you're considering the UK and you don't know what these rule changes mean for you, please do go and speak to your advisors, go and speak to some sponsors, come and speak to us. If you would like to, these rules will come in at pace on the 29th of July. It is quite important to emphasise, though, that clearly this rule set is part of a broader regulatory regime. And we've said that throughout, this is us playing our part in ensuring the strength of UK capital markets. But there are other dynamics at play, and this is part of a broader ecosystem. Others will also need to play their part too.
Who are those others that need to pull their weight, Sarah? Have you already met with the new City Minister, Tulip Siddiq?
So we're very clear that these rules by themselves are part of a broader ecosystem. There are other factors at play, clearly, in companies when they decide to list, the availability of skills, the availability of capital, familiarity with the sector. What we are seeking to do through the rule set is remove some of the frictions that we do know and we have heard get in the way. We're looking to move to a very disclosure-based system so that information is in the hands of investors, so that investors can make their own decisions on where to invest. And we look forward to continuing to play our part as the FCA through future regulatory reform on the other elements where we can contribute. One of the things to signal upcoming is that we have a future consultation coming out in the summer on a revised prospectus regime, which is part of our broader remit that we are, as the regulator, playing our part.
And so how quickly do you expect these rules to actually make a difference to the London IPO market? How are you going to measure that success?
Well, I think here success clearly can't be measured in days or weeks. This long-term success of the UK's capital markets, healthy capital markets, is what we are looking for. But clearly, we would hope to see an increased numbers of companies consider the UK to list. We'd hope to see a broader range of opportunities for investors, so a more diversified market. What we have said that we will do in the rules that we've announced today, as you say, coming in at pace within a couple of weeks, so we'll be live from the 29th of July. We have also said that we will formally review these rules in 5 years' time too.
You've said in your release this morning, Sarah, or overnight, the regulator has acknowledged that it's aware that some market participants won't be happy with this decision. In particular, one of the decisions not requiring companies to seek shareholder approval for significant and related party transactions. Who have you had feedback from? Which parts of the market will not be happy, do you think, with that particular new option, new development?
So what I would like to say first up is we are really grateful for all of the engagement that we have had throughout a really extended consultation process. We consulted through 2 consultations last year in May and December, and we've had extensive engagement directly and through the consultation process with a number of different parties. Broadly speaking, we see real support for the simplification of a single regime, but there are a few areas where there's been a split between sell-side views and perhaps buy-side views on some of those elements, significant transactions, related party transactions, and dual-class share structures. What we have sought to do, though, is to make sure that we are very clear in the market notifications that we will be requiring that the right information is in the hands of investors so that they can make decisions. We believe that a lot of those companies will have the heft to steer the companies that they own. One of the things that we will be looking to in terms of signs of success will also be the increase in that type of engagement between boards and the shareholders in terms of the decisions of significance that you've highlighted.
Sarah, so that's interesting. Sarah, in terms of what you've announced, you've referenced there the dual class of shares. Typically, that's quite attractive to early stage technology businesses. I wonder if this is a set of rules that is designed to attract technology businesses. Is there a risk that you end up losing maybe some names in other sectors? Some have said that London should focus more on retaining the businesses it has rather than attracting new ones. What would you respond to that?
So what we're doing through our rule set is allowing for choice and flexibility. We are not mandating dual-class share structures, but we are permitting them through the rule set. We quite expect that market dynamics and market forces will determine on a case-by-case basis where dual-class share structures are appropriate or where investors have the intention to invest knowingly in a company that has dual-class share structures. They are already permitted under our standard listing segment, so the change here through the simplification of bringing those 2 segments together into one, into a streamlined, simplified single segment, is to give greater possibility for dual-class share structures to be used, but we fully expect these to be negotiated and investors to make their own decisions then in terms of whether they're prepared to invest.
Sarah, thank you very much. Thanks for your time. Sarah Pritchard, Executive Director for Markets and International at the UK's Financial Conduct Authority. So that's the regulatory conversation of the moment. The political conversation is stateside, a focus on world leaders, certainly NATO members gathering in Washington. In that context, Joe Biden under scrutiny, of course, for his performance recently. His candidacy faces mounting pressure after Vermont's Peter Welch becomes the first current Democratic senator to call for the president's withdrawal. Axios has also been reporting that the Senate Majority Leader Chuck Schumer is now open to replacing the commander-in-chief, even though he publicly has been saying that he still backs Joe. This as Biden heads into his final day at the Washington NATO summit, and a press conference awaits him later. For more, let's bring in Bloomberg's Derek Wallbank, who has followed US politics for many years. Derek, good to see you. So it seems like Biden's NATO speech today and his press conference is going to be in focus. What's going to be, what are the things to watch for you?
You know, Anna, I think this is one of those times, sometimes we look at these situations and you say, oh, I need to look at this detailed thing, or there's this thing over here, and this isn't one of those times, is it? This is one where everybody's looking at the exact same thing. What does Biden look like? How's he doing? Does this give you an impression that this is the guy who's got what it takes to go beat Donald Trump? Look, Democrats are candidly scared that Donald Trump may win election again. They are worried about what that would do, and they want someone who can win. It's an overarching thing among Democrats. They want win over purity. They're willing to compromise to get that. But that debate left a lot of people with a doubt in their mind about whether or not Joe Biden could prosecute that case against Donald Trump, and about whether he was the man for this moment. And that's what's led to these calls, right? Is that real clear question, is this the person? You know, Michael Bennet, a senator from Colorado, who has not yet called on Biden to step out, but has suggested that he have a think about his options, said that he's really worried that Democrats right now are on pace for Trump to not just win, but to take the Senate and House as well.
Yeah, I mean, this cast of voices just keeps mounting day by day. Schumer, Pelosi, Clooney. Are we getting to the critical mass, Derek, where it just becomes a question of when, not if, for Joe Biden?
Well, see, here's the thing that I think is different about this situation than most others, is that Joe Biden holds all the cards. He won all the states in the primary process. He has the delegates. He is the nominee unless Joe Biden, in his sole discretion, decides that he's not. So this is not a situation where party grand poobahs can walk up to him and say, oh, well, you know, it's your time to exit. That's not really a thing here. This is a situation where someone has to convince Biden that he needs to go. And one of the things that I think is actually interesting is that there may be some folks who are worried that going out and saying that might cause Biden to want to stay in more. So they're trying to be a little bit careful. There certainly are a lot of people, I think maybe a majority in the Democratic Party, that hope that Biden comes to whatever the conclusion is on his own. We shall see if that happens. But look, Biden has the cards. It's not like a George Clooney or a major donor or even a Nancy Pelosi is going to be the one to say you're out and then he's out. Joe Biden is the one who gets to make that decision. And let's be really clear. The thing that we're talking about as an overarching event isn't just a random press conference. This is a NATO summit. This is a Zelensky is in town and we're talking about how to save Ukraine moment, right? This is a what message are we giving to Russia? What message are we giving to China moment? So there are other things going on. There are conversations this White House wants to have that are not, can Joe Biden string a sentence together? That's not what they want to be talking about right now. They want to be talking about the world's urgent problems. Yeah. But instead, there's going to be a press conference where people are going to be focused on optics more than words, for better or worse.
Derek, thank you so much. Bloomberg's Derek Warbank with all the important context around, you know, it's a press conference later on, Lizzy, about the NATO summit, but it's actually much more than that. It's a check on how the President of the United States is performing and how fit for office he is another time round. These are the events happening today. What stands out to us? Yes, some earnings, some Fed speak, but US CPI, that's going to be the focus.
Yeah, the focus for markets very much. We had the Fed speak from Jerome Powell yesterday, setting the stage for that September cut, not changing the bets really, but does this CPI print actually change the narrative? Of course, the focus very much on the core number that drops at 1:30 p.m. London time. Also on the jobs numbers, because, again, there, Jay Powell expressing his concerns about the labour market.
Yeah, absolutely. And we know that the Fed watches the PCE, but we are expecting that year-on-year CPI number to drop down from 3.3 to 3.1. Will that be enough for September? Stocks in Europe, meanwhile, rallying in the green. This is Bloomberg.